Good evening and welcome to the first broadcast of Bond Squad After Hours. First, we'll get some legal issues out of the way. Investment advice is offered through Private Advisor Group, a registered investment advisor. Wealth Strategy Management, LLC, a Bond Squad, and Private Advisor Group are separate entities. Tonight's broadcast is brought to you by Wealth Strategy Management and Bond Squad, providing full-service financial planning, advisory, and SMA portfolio management located in Stroudsburg, Pennsylvania. Tonight's broadcast is also brought to you by the letters Q, E, and the number 3. Now, you might be wondering why I'm wearing my Rangers sweater, my classic Hockey Hall of Fame Rangers sweater. It's not because we were victorious over the Devils last night. It's not because I want to show off my stylish wares. It was actually to make a point between old and new normals and using hockey as an example. But that's changed a bit with the tragic shooting and killing of a Canadian soldier in Ottawa this afternoon. With that, we'd like to say that our prayers go out to the Canadian people and to the family of the fallen soldier. This is an ongoing problem in this world, and we stand by our Canadian allies. What we did tonight on our first broadcast was to use our classic hockey jersey, or sweater as it's appropriately called, and our composite stick to have a discussion about the old and new normals. We've been of the opinion that the markets or investor allocations were going to go back to a more traditional type of asset allocation, the old sweater, if you will. But times have changed, investors' needs have changed, demographics have changed. So what we might be seeing is a return to the old normal using the new composite stick, as it were. By that we mean asset allocations might be more fixed income heavy than they were in the past. Demographics bear this out. We're seeing most of the wealth concentrated in the upper age group. So we're going to see more interest in income generating securities. What that means is that this idea of allocations out of stocks into bonds, out of bonds into stocks, is really poorly thought out. Why can't there be an either or? We keep hearing arguments saying that bonds are a bad place to be, or stocks are a bad place to be, as if one had to own one or the other. That's not going to be the case. A properly constructed portfolio, in most cases, will have some of each asset class. So we expect that to continue. What we don't understand is why the argument between the two asset classes. It's like arguing what is better to own, a minivan or a Ferrari. Well, the problem is that people have been brought up in the era of mutual funds and ETFs and look at everything on a price basis. We saw it this week, a report on Bloomberg that BlackRock, the mutual fund and SMA company, was selling municipal bonds because they felt that they'd run their course in terms of price. We would venture an educated guess, and we think we'd be right in saying that investors who saw this, and maybe even some financial advisors who saw this news, ran out and said, all right, we're done with municipal bonds. That's it. They have no more price gains. Let's move on to another asset class. But that leaves out the primary reason for owning a municipal bond, and that's tax-free income, at least in most cases. And in that sense, municipal bonds are still attractive. One can get a 10-year municipal bond, AA rated, get almost 3%, 2 3/4, 280. And that's for a state GO or an essential service revenue bond. So, for that purpose, municipal bonds are still quite attractive. The problem is that investors have been taught, especially in the era of mutual funds and ETFs, to look at everything on a price basis. Well, why would one really, truly want to own municipal bonds for price appreciation? That would be capital gain. That wouldn't be tax advantage. So we caution our viewers to take into account why they have exposure to an asset class. In our opinion, owning a municipal bond fund or ETF is not the most efficient way of going about and getting exposure to the municipal bond sector. Actually, owning a portfolio of bonds, in our opinion, is using municipal bonds for their true purpose: tax advantage income. Now, that being said, there are circumstances where investors do not have the investable capital to construct a diverse portfolio of bonds. What we found over the years is that most of those investors who don't have the capital to invest in a portfolio of municipal bonds really are not in a high enough tax bracket to need municipal bonds. So, you can make arguments for it, but in our opinion, if you don't have the investable capital to invest in actual municipal bonds, there are probably better investments for you. Of course, you and your advisor would know that better than I would, sitting here in the beautiful and wet this evening Pocono Mountains. So that's what we have to understand, is why we own municipal bonds. We own them mostly for tax-free income. Now, last year was a once-in-a-lifetime, once-in-a-generation opportunity when news of Puerto Rico and Detroit's bankruptcy became apparent. We saw an outflow out of municipal bonds. Most of that was out of municipal bond funds. The investors called up their advisors, said, "Get me out of my municipals." They went and sold their non-bond municipal investments, funds and ETFs, and the route was on. Portfolio managers sell what they can, not necessarily what they like. So good bonds were sold with bad bonds. For investors who could buy individual bonds, there were some very attractive opportunities out there if you knew where to look and what to look at. We're seeing something similar to that now in the high yield space. When the Fed became more hawkish in its tone over the summer, we saw a risk-off sentiment pervade the markets. We saw it in small cap stocks. We saw it in the high yield bond market. Again, most investors who have exposure to high yield debt, that is, do so in a form other than owning actual bonds. Now, in general, that's not a bad way to go, because as you would learn in a bond market class, high yield bonds, or junk bonds, if you're talking about the very bottom of that part of the market, to be clear, high yield bonds are rated double B plus or BA1 or low. We consider real junk bonds below single B. Right? So those bonds are the most equity-like, especially when you get down into the depths of high yield or junk. The coupons on these bonds, because of the company's precarious financial situations, not a lot of reserve capital, should business conditions, excuse me, I have a cold tonight, take a downturn, the coupon's unreliable. So professional investors, when they invest in the high yield bond market, tend to do so on a total return basis. So what they do is they'll make recovery estimates, especially at the bottom of high yield. They'll say, all right, in a bankruptcy, I might get 65 or 70 cents on the dollar. If I get anything more than that, it's extra, it's gravy, and maybe I'll pick up some coupon along the way. But receiving par at maturity really isn't their primary goal, especially far down the credit rating scale. Again, B minus, but mostly triple C, double C. In the double B area, the area of high yield that's just below investment grade, you'll see some more income investing there. But again, investors must be aggressive or speculative in nature and understand that at that level, the coupons are not a sure thing. The default risk or the debt restructuring risk is that much greater. So when we're investing in high yield bonds, we have to understand that they can't always be used for income enhancement, because income's inherently less reliable. Now, for an aggressive investor who has a well-constructed portfolio and wants to take a little bit of risk, maybe they can add some high yield bonds there. We would add high yield bonds to a portfolio using some of an investor's equity allocation, not their fixed income allocation. Maybe we would use high yield bonds instead of more aggressive dividend paying stocks. Maybe instead of small cap value, a small cap dividend or a mid cap dividend, we would use some double B rated bonds as an alternative to provide some income and maybe potential growth. If you're buying them at a discount, the economy gets better, the business in question's prospects get better, their revenues get better, maybe they're upgraded, and you get some price appreciation from the discount to at least par at maturity. So when we own high yield bonds, we have to understand that our primary goal should not be to generate enhanced reliable income. Enhanced income, yes, at the top of that scale, but not necessarily reliable. And the lower we go, the greater the chance we have of coupon disruptions, defaults, bankruptcies, and receiving less than par through some outcome, usually in a bankruptcy or a debt restructuring. Now, we don't want to make it sound like we're like proselytizing or preaching with all those evil junk bonds, but we have to understand why we own what we own and how the different asset classes work. This afternoon, coincidentally, at lunchtime, on the halftime show on CNBC, there was a great discussion regarding high yield bonds, what they pay as far as yield goes, and possible alternatives. And one member of the panel suggested a product that we have a lot of experience in, and that's preferred securities. And they could be traditional preferred stocks, trust preferred, which are really going the way of the dinosaur due to Dodd-Frank and Collins regulations, but also $25 par bonds, or even $1,000 par junior subordinated securities. That's a mouthful, right? The idea of investing in preferreds as an alternative to high yield bonds was that they pay similar yield. You can get 6% in high yield bonds. You get 6% or better in a lot of preferred securities, as far as yield to worst goes, or yield to maturity, or yield to call. Some of the preferreds are perpetual, so it's going to be current yield or strip yield, which is a topic for another show. But the member of the panel said the only risk you have is with the issuer. And since the issuer, in most cases now, are banks are the largest issuers of preferred securities, and the banks are better capitalized than ever, you're getting 6% without a lot of risk. Well, the guest on the show, or the panelist, is leaving out one important factor, and that's duration risk. Now, subscribers to our reports know that last weekend in our In the Trenches report, we gave a primer on duration, on convexity and bond volatility, preferred volatility. Since most of these preferreds, especially the bank preferreds, are perpetual in nature, they tend to react to changes in long-term interest rates, the 10-year or the 30-year government bond. So when long-term rates start to move higher, the prices of these preferreds will move lower, or should move lower. The lower the coupon, again, this goes back to our discussion on duration versus maturity. The lower the coupon, the longer a bond's duration for a given maturity. So if you have a low coupon preferred, let's say below 6%, and it's perpetual, you're just going to trade off the longest end of the curve, right, you're going to have a lot of volatility there. Maybe just a 1-point rise in rates, in interest rates, long-term rates, is probably going to have somewhere in the neighborhood of 18, 19% decline in the price of that preferred. So you are taking on some risk. It's duration risk. Now, since many of these preferreds are in fact perpetual, there's no maturity date to hold to get par. If anybody would like to contact us directly, we'd be happy to provide examples of preferreds issued by utilities back in the 1940s, 1950s, and early 1960s with very low coupons, 5%, 4%, even in the 3% range, that are perpetual, that are still outstanding. They've been callable for decades, but the issuers have no incentive to call them in. They're getting cheap financing, and they never have to repay the principal. These are perpetual. As long as they can make those 3.5%, 4.5%, 5% coupon payments, they never have to pay this principal back. As such, when rates rose, especially during the late 70s, early 80s, these preferreds traded at very, very deep discounts. They've come back up in price because rates have come down, But even in today's low rate environment, a 3.5% or 4%, even a 5% preferred is a pretty low coupon. So they're still trading at discounts. Most of them are $100 par preferred, and they're trading in the high 80s, at least for the most part. So we have to understand that what we're buying there is a lot of duration risk. Now, fortunately, at least in our opinion, duration risk is not a big concern at this point because we do not see long-term rates rising rapidly anytime soon. Every day we hear equity pundits go in the media and say, next year we got to see 3%, 3%. Here we have to see a 4% long bond, maybe even see a 4% 10-year note. Would somebody please tell us here at Bond Squad why we have to see a 3% or higher 10-year note next year? There's nothing in the cards, nothing on the horizon that would augur for such a jump in interest rates. There's no inflation coming in from overseas. In fact, if you look at Europe, you look at Japan, and now you look at China, they're in disinflationary, if not deflationary environments. So they're kind of exporting that to the U.S. How are they exporting it? Well, their currencies weaken, the dollar strengthens. If the dollar strengthens, the dollar increases purchasing power. If the dollar increases purchasing power, the price of goods priced in dollars, which is just about every commodity in the world, goes down. So that's disinflationary over here in the United States. Excuse me. So that trend we expect to continue. There's been a lot of discussion about ECB President Mario Draghi is going to engage in QE. He's going to buy sovereign debt. Today it was announced that he was buying covered bonds. Covered bonds are usually bonds issued by banks with a pool of mortgages or other collateral loans that are backing. Not quite a mortgage-backed security or an asset-backed security. They're really corporate debt that is secured by a pool of other assets. But when he does this, Europe is going to bounce back, and they're going to grow, and we're going to see inflation overseas. It's probably not going to happen. They have deep structural problems over there. They have a demographic problem. The birth rate is falling close to zero. You have inflexibility among businesses. It's almost impossible to start a business there. It's almost impossible to move a factory, to automate a factory, to adjust the size of your workforce. Youth unemployment is well into the double digits, over 20% in most areas of the Eurozone. So the Eurozone it promises to be the sick man of the global economy for quite some time. And the bond market seems to have figured this out. We saw a lot of volatility today in the equity market. Equity market closed down, or the Dow closed down over 100 points. The bond market was unchanged. It closed the 10-year, we closed at 222, which makes us think of Karen Valentine for some reason, but you baby boomers out there know what we're talking about. We closed at 222, right? Unchanged on the day. The bond market is telling us that there is no inflation, at least no worrisome inflation, on the horizon. Now, the bond market's been telling us this for a number of years. Now, before, we couldn't be sure exactly what the bond market was telling us because the Fed was involved for the first time in history in buying very elongated securities, and very long for the Fed, 5, 7, 10, and sprinkling beyond 10 years. But usually the Fed, even when it was involved in QE1 and QE2, it was buying short-term securities. So the Fed is buying long-term securities, suppressing long-term rates. So the market, and even we here at Bond Squad, weren't sure exactly what the bond market was telling us as far as its views on inflation. Well, the Fed is most likely, and we don't think there's a doubt in the world of this, that the Fed is going to stop or end its QE asset purchases at next week's FOMC meeting. So by now we have a pretty good idea what the bond market thinks of of inflation expectations. And a 222 10-year, which dipped below 2% on capitulation last week and hasn't been near 3% since the beginning of the year, we believe that's telling us that inflation is not going to be a problem. It's also telling us that growth is going to be moderate. GDP will probably print somewhere around 3% this quarter. The street consensus is high twos to three for the fourth quarter, but that's probably what the economy is capable of at this point, especially when you consider the drag from overseas. Yes, we're not as dependent on exports as other countries, so the foreign economies won't have as much of an effect on us as we would on them. But there's going to be a modest drag. So instead of going at 3.5, it might grow at 3. Instead of 3.2, it might be 2.8. But there's going to be some sort of drag in this. And the stronger dollar is what's responsible for that. The stronger the dollar, the more expensive foreign goods are. The cheaper, rather, foreign goods are here in the U.S., the more expensive foreign goods are overseas. What we have to also realize is that the stronger the dollar is, the stronger foreign labor is. If I'm paying somebody in Thailand, 100 Thai baht, well, and the dollar appreciates 10% against the baht, then labor just costs me 10% less in Thailand. It's a very simplified explanation, but that's how it works, and that's what we're seeing in the labor market. We're seeing U.S. workers in competition with foreign labor and with automation, and companies are putting in whichever source of production is most cost effective. So, and that's probably not going to change. We've also seen part-time work, economic, and even healthcare regulation reasons become a permanent part of the labor market. It used to be that part-time work was full-time work. That might not be the case anymore. So we're in a different world. We're not in this old wool sweater world anymore. We're in the composite stick world now. Things have changed. Tastes have changed. We saw changing taste in the earnings of Coca-Cola and McDonald's. Not only were the overseas sales down, which they blamed on the strengthening dollar, we saw the domestic sales down. The sales among millennials are really suffering. Millennials are those, let's say, 30 years of age and under. They're not big drinkers of the classic sugary drink, and they're searching out alternatives to the fatty, greasy hamburger. So the taste have changed. So they're looking for healthier options. It's not good, it's not bad, it's just different. And that's what we have to understand. It's different. A lot of things are different. Housing is different. Millennials do not have the desire to own that suburban McMansion, 4,000 square feet, acre of property with a lawn to mow, property taxes, in some areas of the country going into five figures. And student debt is making the matter worse, but it's not the primary reason, in our opinion. The primary reason now is change, is technological change. Millennials don't have the same desires as their parents, and maybe in some of their older siblings in families which span Gen X to millennial. They want urban lifestyles, conveniences nearby, amenities, wireless internet. That's what they want. They don't want to have to worry about repairing a roof or watering a heater, mowing the lawn. They have different priorities. And we've seen this all along. After World War II, and we wrote this in today's report, after World War II, GIs coming back from the war, were attracted by the Levittowns, both in Bucks County, Pennsylvania, Long Island, New York, and other areas of the country with some of the developments, to these small ranch or starter homes with a white picket fence, rows and rows of the same type of home. And they raised sizable families, and that was their desire, that was their goal. Their kids were the McMansion buyers, were the baby boomers and the Gen Xers. They wanted the McMansion. They saw what their family had, but they remembered that they were cramped when they had families of 4, 5, 6 kids in the small house. They aspired for bigger and better homes, the SUV, the 2-car garage, the lawn. I've arrived. It's a different priority for the younger generation. They tell people they arrived when they have their smartphone, when they have their tablet. That's how they let the world know that they've arrived. And quite honestly, it's a lot easier than maintaining the home, than mowing the lawn. It's just different priorities. So if we're waiting for this old normal to reappear, It's probably not happening in in the current generation. This is going to be a longer term a longer term trend away from, at least in our opinion, away from the suburban McMansion to more of an urban lifestyle. So, yeah, that's where we think we're going. We think that we're in a long term. We'll never say permanent because things always change, but a long term, low rate environment. We think that we're in a change, in a structural change in the economy as far as labor goes, and we also think that we're seeing a structural change to consumer tastes. And make no mistake about it, although the boomers are a larger part of the economy right now than the millennials, it's the millennials that will be the spending longer. The boomers, they're going to be on fixed incomes, and eventually, unfortunately, happens to everyone, they're going to pass on. So it's going to be the millennials that are going to be the drivers of the economy a decade or so down the road, if not already. So we're going to see that change in tastes, and we're going to see that in the markets too. You know, maybe at some point we'll see this move back to equities when the millennials get it. But here's the problem with that: the millennials should be investing in equities now, but they don't have the money to invest. By the time they get to invest, they're going to be looking for more of a balanced portfolio. So that's where we stand right now. Is that we're now in a structural fundamental change to both the capital markets and to the economy. So that's what we have for this evening. We have the questions. The questions get open on the Google Hangout. If anybody has questions, if you'd rather ask questions on email to be answered at a later time, you can email us at thomas.byrne, that's thomas.byrne as in whiskey, S as in Sierra, the word and, the letter M.com, or you can call us on our office during office hours at 570-424-1555. Again, thank you for joining us on our inaugural broadcast for Bond Squad After Hours. Yeah, we planned on being a little more pithy, but with the events that happened in Canada today, we just didn't think it was appropriate to try to be a little more pithy or funny. We played a little close to the vest today, but that was out of respect and deference to the event there. And with that, we'd like to wish everybody a good evening. Thank you.